Welcome back. You're tuned in to Power Breakfast here on CNBC TV 18. Now all eyes will be on the macro data that's due later this evening. A CNBC TV 18 poll pegs the CPI inflation for the month of May accelerating to around 3.1%, while the industrial production for April is seen at around 0.32%. Ritu Singh joins us to tell us what to expect. Ritu, over to you.
Thank you for that. I'll start with the May CPI data first. According to a CNBC TV 18 poll, the retail inflation for the month of May is seen rising to 3.1% versus the April CPI figure of 2.92%. And this is largely on the back of rising food prices. Remember, the WPI figures for April also showed that food inflation had risen by over 7%. The April CPI urban food inflation figures were also higher by about 4%. So there has been a sustained rise in food prices, something that will play into the May CPI figures, now seen higher. The range that the economists that we polled for May CPI was between 3.04% and 3.2%. Another thing that we'll be watching out for will be the core inflation data. While for the month of April it had come off to below 5%, is the fall in core CPI sustainable? That is also something that we will be watching out for. Now, as far as the IIP data is concerned, there hasn't been much good news on this front in the first 3 months of this year. For April, the CNBC TV 18 poll sees IIP at 0.325% compared with a contraction of minus 0.1% in the month of March as far as IIP is concerned. Particularly, we'll be watching out for the manufacturing sector, which, remember, has now declined for 2 consecutive months, and also the capital goods sector, which has posted 4 consecutive months of decline. Now, these are the worrying factors, the 2 key points really in IIP numbers that we'll be watching out for.
Okay, thank you, Ritu, for that. But on that note, let's also listen into a slice of a conversation that Lata Venkatesh had with former RBI Governor Y.V. Reddy on India's growth concerns as well as the macro worries.
Potential growth or the expected growth of India seems to have declined. I mean, we thought we are almost a God-given right to 8%. Now 7 is a struggle.
Yes, for 2 reasons, definitely. See, ultimately, there are 2 things which are required. You require investment, backed by savings, and they require productivity. There is no evidence of growth in total factor productivity, and actually the household savings are down, and therefore how do you increase the potential output unless you increase the investment and or productivity?
Okay, we are faced with a new reality in terms of inflation. In the last 24 months, it has been around 4%, but in the 70 years prior to that, the average was 7.5%. And even if you take the last 30 years since 1991, the reforms, the average has been around 5 to 6%. So should we assume that this is a temporary aberration and that we may mean revert?
I would divide into 3 components: food, fuel, and others. Now, if you break up, I think the oil prices have been very benign. And that's more because the global oil prices than us. As far as food prices are concerned, I think overall over a period, the food inflation has been somewhat constrained because the supply of food is now more or less inelastic, and so is the demand. It's sort of settled down.
Okay.
The issue is
if that is true, then we should have benign food inflation.
I presume so. I would think so. And it has been so, I thought, for the last 5 to 10 years. Except for a brief while.
No, yeah, in between 13 to 15, we did have high food prices as well.
2 years. 2 years. But globally also, another thing is globally, non-food, non-fuel inflation has been subdued.
Yes.
And therefore, in a way, if you recall, we were also going towards 5%. Ceiling of 5%, 3 to 5%.
Yes.
So it is a long-term trend, but I think now, in a way, we are closer to the global inflation, provided that it's, however, this will not be applicable as far as food and fuel are concerned.
Okay. No, the point I'm asking you is that can we now believe that we are in a lower trajectory for a sustainable period?
See, in fact, the question is whether the monetary policy should take credit,
okay,
or is it because the supply and demand factors which have been taken care of in a particular manner. So the limited point I am making is that given our situation, The capacity of the monetary policy to influence inflation is somewhat limited.
Okay. Okay. No, I take your point that lower interest rate has not in the
Both
past.
because of the dominance of fisc in determining the food and fuel prices.
Okay. Okay.
Second, the autonomous nature of their supply. And third is the transmission mechanism both through the banking system and administered interest rates. So a configuration of all these forces makes monetary policy far less effective than is assumed in theory.
Okay. Okay. Well, let me come to fiscal space. Do you think the government has the fiscal space to stimulate investment and consumption?
The way I look at it is, in a way, the high interest rate for the borrower and in a way low interest rate for the saver is because of financial repression. Fiscal sustainability is happening because of financial repression.
Okay.
And also because in the recent past you have allowed government paper to be picked up by non-residents. And then there is a lot of monetization of the government debt by the RBI. So in a way the fiscal sustainability that you see is at a cost. And that cost can't be incurred repeatedly.
Okay. And that cost is hurting growth,
Yes.
you would say?
But at the same time, there are issues in the economy which are stalling growth. And those issues will have to be resolved, and that may require fiscal support. So in a way, in the short term, you have to have a targeted stimulus without sacrificing the medium-term fiscal consolidation part.
Okay.
Something like a pause. A pause.
A pause for 1 year
or 2 years
on fiscal
on fiscal
consolidation
side,
is advisable?
But that has to be in the following way, in the sense that it should not be on the tax side because it's really difficult, and how it will respond will depend on the taxpayer. Expenditure is better, targeting is better through expenditure, and the infrastructure solution is not exactly right because infrastructure by the time you devise new projects, so it should be acceleration of the projects. But I believe that the greatest scope for stimulus through public enterprises.
Okay.
Central public enterprises and state public enterprises, they are less leveraged compared to private sector.
Okay, all right. Time to